What if I told you that the person you trust most with your retirement money, your financial advisor, is legally allowed to recommend investments that benefit them more than they benefit you? What if I told you that the advice you've been following for years, the plan you've built your entire retirement around, was designed not to maximize your wealth, but to maximize their commissions? I know that's hard to hear, because most of us have sat across the desk from someone in a nice suit, in a nice office, with certificates on the wall, and we thought, this person is on my side. But the uncomfortable truth is this: the financial advisory industry is one of the least regulated, most conflicted industries in America. And in 2026, with inflation still elevated, interest rates unpredictable, and Social Security under pressure, the stakes have never been higher. The wrong advice isn't just frustrating, it's devastating. I've spoken with retirees who did everything their advisor told them to do. They saved, they invested, they followed the plan, and they still ran out of money in their 70s, not because they didn't save enough, but because the system around them was quietly taking its cut every single step of the way. Today I'm going to walk you through the 5 biggest lies that the financial industry tells retirees. These are not opinions. These are documented, researched, undeniable facts. And by the end of this video, you will know exactly what to look for, exactly what questions to ask, and exactly what steps to take to protect your retirement income starting today. Before we go any further, do me one favor. Hit that subscribe button right now. Every week I release information like this completely free. Information that could save you tens of thousands of dollars. Subscribe, hit the bell, and let's get into it. Lie number 1. Your financial advisor is legally required to act in your best interest. This is the biggest and most dangerous lie in the industry, and most retirees believe it completely. Here is the truth. There are 2 different legal standards that financial advisors operate under. The first is called the fiduciary standard. A fiduciary is legally required to put your interests first, period. The second is called the suitability standard. An advisor operating under the suitability standard only has to recommend investments that are suitable for you, not the best ones, not the most affordable ones, just suitable. And the majority of financial advisors, brokers, and insurance agents in America operate under the suitability standard, not the fiduciary standard. That means they can legally recommend a mutual fund with a 1.5% annual fee when an identical fund with a 0.05% fee exists, simply because the higher fee fund pays them a better commission, and they are not required to tell you that. Think about what a 1.5% annual fee means over time. On a $500,000 portfolio, that's $7,500 every single year. Gone. Before your money even has a chance to grow. Over 20 years, assuming modest returns, the difference between a high fee fund and a low fee fund can exceed $200,000. That is not a small number. That is the difference between a comfortable retirement and a stressful one. So the very first question you must ask any financial advisor is this: are you a fiduciary? Are you legally required to put my interests first at all times? If they hesitate, if they give you a complicated answer, if they say it depends, that is your answer. And it should be a red flag. Lie number 2. Annuities are the safest way to guarantee your retirement income. You have almost certainly heard this pitch before. An advisor sits down with you, pulls out a chart showing guaranteed income for life, uses words like protected and secure and guaranteed, and suddenly an annuity sounds like the smartest thing you've ever heard. Here is what they don't tell you. Many annuities come with surrender charges that can lock your money up for 7, 10, sometimes 14 years. If you need access to your money during that period, for a medical emergency, for home repairs, for anything, you can face penalties of 10% or more. Additionally, the commissions on annuities are among the highest in the financial industry. An advisor selling you a $300,000 annuity can earn a commission of $15,000 to $21,000 in a single transaction. That commission comes out of your investment, and it creates an enormous incentive to sell you an annuity whether it's the right product for you or not. Now, I'm not saying all annuities are bad. Some simple, low-cost annuities can be a reasonable part of a retirement income strategy, but complex variable annuities and indexed annuities with high fees and long surrender periods benefit the advisor far more than they benefit you. Lie number 3. The stock market is too risky for retirees. This is the lie that keeps millions of retirees in low yielding bonds and cash accounts while inflation quietly destroys their purchasing power. Yes, the market has volatility. Yes, there are down years. But here is what the data actually shows. Over every 20-year period in American stock market history, the market has delivered positive returns. Every single one. A retiree at 65 with a 20 to 25-year time horizon has more than enough time to ride out market fluctuations and benefit from long-term growth, keeping all your money in so-called safe investments that return 2 or 3% when inflation is running at 4 or 5% means you are losing purchasing power every single year. That is not safety. That is a slow guaranteed loss. Lie number 4. You need a professional to manage your investments. The financial industry has spent billions of dollars convincing ordinary Americans that investing is too complicated to do yourself, that without a professional guiding you, you will make catastrophic mistakes, and that paying 1 or 2% of your assets every year is a small price for that peace of mind. Here is the truth that the industry desperately does not want you to know. Study after study, including research from Vanguard, Morningstar, and Standard & Poor's, has shown that the vast majority of actively managed funds, the funds that professional advisors recommend and charge you to be in, underperform simple, low-cost index funds over a 10 to 20-year period. That means the average retiree who puts their money in a simple S&P 500 index fund and leaves it alone will outperform the majority of professionally managed portfolios, not because they are smarter, but because they are not paying the fees, the commissions, and the transaction costs that erode returns year after year. This doesn't mean you should never seek financial advice. Tax planning, estate planning, and social security optimization are areas where professional guidance can genuinely add value. But for the core of your retirement portfolio, the evidence is overwhelming. Simple, low-cost, diversified index funds will serve the average retiree better than the vast majority of actively managed solutions. Lie number 5. You can't afford to retire without more money. This is the fear that the financial industry uses to keep you saving, keep you investing, and keep you paying fees for as long as possible. The truth is that retirement readiness is far more about strategy than it is about balance. Retirees who understand tax efficiency, who know how to sequence their withdrawals, who optimize their social security benefits, and who manage their healthcare costs, strategically can retire successfully on far less than the industry's standard formula suggest. So what do you actually do with all of this? Let me give you 5 concrete actions you can take right now to protect your retirement income and stop the silent drain on your wealth. Action number 1. Ask your advisor in writing whether they are a fiduciary at all times for all services, with no exceptions. Get it in writing. If they won't provide it, find an advisor who will. Action number 2. Pull out every investment statement you have and look for the expense ratio on every fund you own. If any fund has an expense ratio above 0.5%, ask your advisor why you are not in a lower cost alternative. The answer will be very revealing. Action number 3. If you own an annuity, find out the surrender period and the total fees including mortality and expense charges, administrative fees, and any rider fees. Add them up. The total may shock you. Action number 4. Open a free account at a low-cost brokerage like Fidelity or Vanguard and compare your current portfolio to a simple 3-fund portfolio of low-cost index funds. The comparison will be eye-opening. Action number 5. Before your next advisor meeting, write down 3 questions. What is your legal obligation to me? How are you compensated for the products you recommend? What would this portfolio look like if you had no financial incentive? The answers to those 3 questions will tell you everything you need to know about whether your advisor is truly on your side. Here is the bottom line. You worked your entire life for your retirement money. You earned every single dollar of it. You deserve an advisor, a strategy, and a plan that is designed entirely around your interests, not theirs. Share this video right now with every retiree you know, because this information could save them thousands of dollars. Drop a comment below and tell me, has your financial advisor ever been fully transparent with you about fees and commissions? I read every comment and I will personally reply. Subscribe and hit the notification bell right now, because next week I am releasing the complete guide to building a retirement income portfolio that generates $4,000 to $6,000 per month without an advisor, without high fees, and without unnecessary risk. You do not want to miss that video. Subscribe now, and I will see you next week.